Welcome to Shareholder Primacy from Free Float Media, a podcast about activist investing, securities law, and all the ways the financial and legal worlds intersect and collide in real life. We are back, Ann and me. Ann Lipton is a law professor at the University of Colorado who teaches and researches securities and business law. She holds up the legal end of our podcast.
And that's Mike Levin, an activist investor who lives and works in Chicago. He covers the financial side of our podcast.
All right, I tried him. Hi, everybody. Sorry we skipped you last week. It was just busy. One reason it was busy is because Ann was on the Odd Lots podcast, Joe Weisenthal at Bloomberg, and it was really good. Much bigger following there than here,
and Tracy Alloway, yeah.
And Tracy Alloway, yeah. So I would encourage, if you really, if everybody missed our content, go back and find that one. It's on your favorite podcast distributor. But we're back now. Should be on a regular schedule for a little while until Ann's travel schedule interferes.
Don't forget, you can, in fact, email us questions or things that you would like us to discuss at shareholder primacy, one word, at freefloat.llc.
Well, great. We have two subjects today that Ann and I kind of cooked up that actually, I don't know what you think. I think they perfectly represent what we're about here at Shareholder Primacy, the podcast.
They do. Yes.
There's interesting and relevant questions and controversies that have both legal and financial angles and implications. One of them is the news that ExxonMobil, which is like kind of late breaking, will implement this novel form of proxy voting for its retail shareholders. It got a huge amount of attention and discussion this past week. And second, or next, or before, it looks like the SEC may change a very basic reporting requirement, the basic requirement for U.S. public companies to report quarterly financial results. So we decided to talk about both. How about we start with the news about quarterly reporting? That okay, Ann? All right. So what was that news? And then we can dig into it.
So in Trump's first term, I should say, there was sort of questions about whether they should end quarterly reporting under Jay Clayton. And that sort of died. And then suddenly, Truth on Donald Trump's Truth Social network, he said I'm not going to read the whole thing, but he truthed out.
Truth, is that the verb? Truth. Yeah, I think the verb is to truth. Yeah, you can do the declensions. I truth, you truth.
Exactly.
We truth.
He truthed out. Subject to SEC approval, companies and corporations should no longer be forced to quote report unquote on a quarterly basis, and rather to report on a quote 6, then 6 and the numeral 6 in parentheses, month basis. This will save money, etc. So the SEC then said that it would investigate and they were going to prioritize
like
this
that
proposal.
Day, like that hour. I mean, the SEC, I don't know if it was Atkins or one of his people, but right away they said.
Yeah. So they said, so obviously this is something that the SEC is definitely going to look into. Whether what happens, we'll see, but they are definitely going to look into it.
Right. And they are going to prioritize the proposal, which to people who've been waiting years or longer for other regulatory changes, it's probably a little disappointing. But anyway.
Well, I don't know. They seem to be moving very quickly when they want to these days.
Right. And so, but this isn't new. I mean, this has come up on and off over the years, right?
Yeah. Mm-hmm.
When was the last time they discussed it?
Well, no, this is so 2018. But they never acted on it. So
right, no, they got a bunch of comment. I mean, they put out some sort of a release or some sort of request for comment, I think.
They did, and they got lots of comments, and they exactly what you would expect, and then they never actually did any rulemaking on it.
So if the SEC were to go change something, what law or regulation or whatever are we kind of talking about here?
Yeah, so you have to understand that all of these interim reports, this regular reporting, that's required by the Exchange Act, the Securities Exchange Act of 1934, but the Act gives the SEC a lot of discretion to decide how often to require reporting. So right now, the SEC requires, a comprehensive annual report and then 3 interim quarterly reports, which are more sparse. And it wasn't always like this, by the way. Until 1970, the SEC only required semi-annual reports. But the exchanges, the New York Stock Exchange, they required quarterly reports, and eventually the SEC in the 1970s. But those reports, they were unreliable, they were sparse, they weren't particularly uniform. So in 1970, the SEC started to require quarterly reporting. So if the SEC wanted to change it, it could do that by changing its own rules, or of course Congress can always step in and override and mandate.
Oh, so that was interesting.
Reporting.
So there had been a listing requirement, so to list on. Yeah. Well, at the time, the New York Stock Exchange was dominant and NASDAQ was puny, but probably both.
I don't even know if it was an exchange in 1970.
Maybe, I don't know. Right.
So
they had a listing requirement that people kind of probably followed.
Yeah, they did, but my understanding is those reports were very unreliable, which is part of the reason why the SEC decided to bring it under the regulatory umbrella.
Go ahead.
No, and I should also add that this isn't just coming from Trump, actually, but even before he truthed, the long-term stock exchange.
Oh, right.
Sought permission from the SEC to allow companies listed there to report semi-annually if they want to.
Oh, so their listing requirement.
They want it. They want to make it.
They would like to have a listing requirement that is only semi-annual reporting.
But they would need relief from the current requirement of quarterly reporting. And, I'll just say, the theory that the justification is, one, quarterly reporting is expensive, it's time consuming, but mostly the theory here is that if managers don't have to look just to the next quarter, if they can look out 6 months, they will be less short-termist in their approach to how they manage their resources.
Right, and I may want to return to that in a moment.
Yeah.
So anyway, so this is the 13th. When people talk about the 34 Act, I always hear lawyers talking the 34 Act or the 33 Act. This is the 34.
They're actually. I agree. They're actually very different in what they regulate, but it's the 34 Act that requires ongoing reporting.
And that's through. And then the regulation is, I think, SK. And
well,
then
these are regulations that are promulgated through just Section 13 and Section 15, but the Reg SK is part of what gets reported.
Got it. And then it's the 10Q. And so there's not going to be maybe a 10Q anymore. Maybe it'll be the 10.
Well, it used to be a 9K. The old semi-annual was 9K. Bring back the 9K.
Okay, that's what they want to do. All right. Oh, so that's good. That's some good context. So you're probably wondering.
Yeah. So what do investors? So yeah, I mean, I know what I think, but what do actual investors who actually consume these for actual financial reasons?
We kind of like quarterly reporting. It gives us purpose. It gives us an excuse to say, "Oh no, I got a quarterly call I need to be on. I can't meet with you," or I got quarterly filings I need to read. So it's a great way to kind of bury yourself in work and not have to talk to other people for a day.
That's an advantage.
Yes. But overall, the idea of quarterly reporting, it just creates this kind of cycle. And most investors don't quite think of it. There's some traders and so forth that think of it as engendering some form of short-term thinking. But most, analysts, most activists for sure, who are, in a stock for a lot longer than, the next quarter or two, kind of like it because a lot can happen in a quarter, believe it or not, especially at the kind of, I'm going to say troubled, but companies that are concerning, stuff happens quarter by quarter. It's rare for like a company that I'm looking at or I'm working on for you to have a stretch of 2 or 3 or 4 quarters where like just nothing's going on, where it's just very stable. So the idea of that kind of reporting also at least in an active, is kind of helps hold management accountable. Now we understand it's a complete hassle. If they could, they'd probably save a little bit of money in having only report, every quarter. But most of these companies do monthly closes. The cost to do 4 quarters instead of 2 quarters is probably not going to be that significant, and I'm guessing. Companies won't mind going to twice a year. They'd prefer to report only annually or prefer to never report. Right. I mean, they view shareholders kind of a nuisance. So I don't think they would object to this, but I don't think they're, going to be huge cheerleaders, for this either. Clearly this was some sort of a notion somebody planted in our president's head, and he kind of just, barfed it out.
I don't know.
So a couple other comments about there. There's a lot of habits and so forth. I started alluding to that is linked to quarterly reporting. A lot of trading, a lot of derivative settlement.
Oh, I
There's
see.
a whole bunch of
So
stuff
that would get, yeah.
that gets tied to that. And if you miss that, there's going to be a lack of we're going to lose some transparency and
Right.
and the markets market pricing of securities is going to suffer, at least in some small way. So just kind of breaking those habits that have built up, a lot of systems and so forth, is going to take some doing to adapt to that. It's also worth noting that at least some of what I've seen, and most of talked to a couple folks about this, most companies are going to still remain with a quarterly cycle.
Yeah, so that's one of the questions that, even from an academic perspective, is so are companies going to choose to do this, or are they going to feel market pressure to do quarterly reporting?
Even if
it's not legally
that's interesting.
required.
There might be some market pressure. There might be some companies that say, we're gonna, and then they'll, we're gonna take advantage of this new reg. We're going to report, and they may get some pushback.
Yeah. So that's that. I mean, that I think from an academic perspective, there's a lot of curiosity about that.
Yes, and so my expectation is most companies, probably almost all, for a while, will remain on a quarterly schedule. It just, again, they're used to doing it. Their systems are built up for it. Our systems for analyzing them are kind of arranged around that, and so there's not a whole lot of gain. As I said, the marginal cost savings is not going to be that significant in terms of your filing, in terms of doing a quarterly close, and so forth. Now, you started asking, or we brought up for a moment, the ostensible motivation.
Yeah,
for
does
this.
it really will the difference really make a difference in terms of long-term capital allocation?
Now that is a raging debate about how much or how little it'll affect this so-called shorter long-term thinking. And there's all sorts of division among practitioners and active investors and academics. No one is even sure kind of what they mean by that. There's a lot of arbitrary definitions and
Right.
What it means to be short and long term. People kind of have a feel for what it is. We because we're kind of slaves to the short term, quarterly reporting, we can't make long term investments. Well, I think that's baloney.
Yeah.
I mean, you find
I already seen it pointed out. AI is nothing but throwing money at long term,
throwing very long term investments. Exactly. But it's not
hoping that
just
it'll become
AI.
profitable.
Look at huge infrastructure plays. Big utilities or whatever. They're investing for 10, 20, 30. They're investing way out. Okay, and they're still subject to the same kind of quarterly pressures. Sure, there's going to be exceptions. There's going to be some investors that kind of give us activists a bad name, who are just kind of dodging in and out. There's traders, arbitrageurs, and so forth. Okay, but most routine investors, and activists included, are kind of understanding of this. In some respect, this is a little bit of an invented problem. Okay, trying to because basically when you have a management team that's complaining about the pressure of quarterly reporting, it's not the quarterly reporting that they're worried about, it's the pressure. It's the idea that they are kind of subject to this kind of scrutiny, especially if they're not doing so well. I've said all along, and there's a lot of theoretical and some empirical backup to what I'm about to assert, that the long term is just a series of short terms. Okay, you could sort of do the math and show that pretty explicitly. Okay, clearly there's not, there's going to be differences there, and you're going to have exceptions. But overall, when companies are complaining about the quarterly reporting as being a symptom of this kind of short-termism or whatever, You don't ever hear investors kind of saying, this is a big problem. It's always companies that are complaining about it. And what they're doing is they're complaining about scrutiny.
Yeah, exactly. They're complaining about being, beholden to investors. They're not actually complaining
right. Well,
about
they should have thought about that when they went public.
Yeah.
when they took public money.
Yeah.
Rather than, now that they're, some of them are whispering in our president's ear saying, maybe we should try this. Yeah. So, I think the other interesting illustration here is that the idea, and this is something we should probably talk about at some other point, is that the idea that companies may still adopt a quarterly schedule.
Yeah.
In light of a potential 6 month. And I don't know. Do you have any sense of what the likelihood of this might be?
No, I mean, we're all waiting. I mean, one thing that Andrew Jennings was pointing out, another corporate professor, is
another good academic. You're right.
Yeah, he that companies voluntarily do those earnings releases right when the quarter ends. Nobody's requiring them to do that, and they do that anyway. So,
Right. There's no requirement you do guidance.
Yeah. So.
Right. And so that's a perfect example of the thing we have to talk about one of these days, which is private ordering.
Yeah.
This is an example of a company adapting to its specific investors' needs outside of what the regulations require. Mm-hmm. There may be companies that go list on the long-term exchange, and they know that their investor base is only wants every twice a year reporting or whatever. So anyway, but that's the other thing that dawned on me is I said, this is private ordering in action.
It is private ordering in action. But I mean, I'll just from my perspective, I don't study the reports. I just invest in mutual funds and try to forget they're there. But
yes, right.
I just have two concerns. So the more minor, not minor, but micro concern is when you give managers that kind of, when you give corporate managers that kind of informational advantage for a prolonged period of time, there's just more opportunity for them to exploit that. Insider trading is and tipping would be almost the least of it. But there are just so many different ways that managers and people in those circles will be able to, leverage informational advantages relative to the public. And the longer
if they don't have to disclose it to shareholders, there's things they could be doing,
all
or
kinds
not
of
doing,
things.
or whatever. You're right. Okay.
Yeah, and also anyone in their circle, and it gives very, very large traders something of an advantage. I mean, it's just at every scope. But the other issue, and this is really just my macro concern is that I think quarterly reporting, corporate reports, they're a public good in the sense that it's not just for investors; everyone can read them. And that means everybody gets an insight into the economy all the time through these kinds of reports. Yeah. And I feel like we're entering an era when a lot of public information goods are being degraded. So we have our whole thing over the Bureau of Labor Statistics, and we have cutting the budgets at CDC and NIH. And,
or environmental data.
And environmental data. And we will certainly be talking about the potential move to arbitration for securities actions, in which case that information is lost. So, I mean, I think this is just yet another, chipping away at this wall of public information that's been available for everybody, investors, the public, researchers, journalists, and I think it's very dangerous on all these fronts to lose access.
That's a great point. That this is a symptom of much larger problem of, dare I say, elites concealing their behavior and decisions or data from the public.
Exactly. And then that, once again, gives more advantages to people who have the real data and more opportunity to mislead the public with false data. I mean, I think that there are a lot of
big asymmetry is possible here.
Yeah, exactly.
All right, cool. All right, let's, how about we take a quick break and come back and we'll talk about ExxonMobil, which is also fascinating, and their new proxy voting program, as we shall say, here at Shareholder Primacy.
Shareholder Primacy is brought to you by FreeFlowAnalytics.com, the only free database of corporate directors, their influence, and their performance. If you own a stock or retirement plan, go to FreeFlowAnalytics.com and look up which of your elected directors are performing well and which aren't. Use your vote in the alternative democracy and get your data at FreeFlowAnalytics.com. Now, back to the show.
Welcome back to Shareholder Primacy. I'm Ann Lipton here with Mike Levin, and we're going to talk about ExxonMobil and a new idea they have to help shareholders vote at annual general meetings as long as the shareholders vote with Exxon.
Right. Yes, that's a very good point. We will get there.
Yeah. So what's the news, Mike?
So Exxon, I think, and it was sort of a surprise. I didn't hear any rumors of this at any point.
Okay, so here, and you can tell me how this lays out. Reporters knew in advance, but couldn't report.
Oh, so they had released it and embargoed it. Oh,
yes.
Okay. And that was like probably 2 or 3 days before.
Yeah.
It wasn't like it was weeks and weeks in the making. Oh, okay. Oh, sure. Okay. So I had not seen, and I try to study what's kind of going on. I hadn't seen any kind of form of this talked about, like at conferences or in papers. I hadn't seen any kind of
I had never heard of it.
Academic paper that kind of laid this out.
There are all kinds of papers about things like this for retail, but not coming from the company.
Right. So, and let's talk about what this is. It's a program that Exxon is going to run themselves. It would be for only their retail shareholders, not institutions. So, and nobody under, we were talking about acts, nobody under the 40, I don't know who's the investment.
Nobody under the 40 Act, exactly.
40 Act, I do that right. Oh, good.
Yeah.
No one who has to comply with the 40 Act can do this. So it's all individuals like you and me. And I would describe it as a perpetual, but not an irrevocable proxy. Those are my words. It's not ExxonMobil's. And so basically, ExxonMobil will allow shareholders to tell them once that this is how I'm going to let ExxonMobil vote my proxy. They're going to hold my proxy, and the shareholder doesn't need to like every year complete a new one. So you just do it like one time, which seems kind of good for shareholders, but we'll talk about some of the complications in a minute. ExxonMobil will allow you to make one of two kind of elections when you appoint them, kind of perpetual proxy. Either you can allow ExxonMobil to vote your proxy for all board-supported recommendations. So if there's a shareholder proposal that the board wants you to vote on, they'll vote yes. If there's a shareholder proposal they oppose and Exxon's board votes no, they'll vote your proxy no. For say on pay, inevitably they're going to say votes yes on say and pay. So they're going to vote your proxy for yes on say and pay. So you can either follow all of the board's recommendations or all except the board election.
No. Contested board elections.
Oh, contested board elections. Thank you.
Oh,
I didn't realize it was contested. Oh, thank you. Only or on a contested and any M&A deal, any kind of acquisition, divestiture, investment.
That requires a shareholder vote, like legally requires. Not a voluntary one where it's like for cleansing.
So if you elect that latter one on a contested election, you'll need to, and you want to vote, you'll need to go get a proxy, which I'll do in a minute. I'll talk about it in a minute. But if you elect the former, where you follow all board recommendations, it'll be for all directors as well. All right. Now, ExxonMobil has a couple of other convenient things that they're going to do for these shareholders, which is they will remind you annually that you're a part of this program. Send you some sort of a piece of mail or an email saying, don't forget, you appointed us your perpetual proxy. So shareholders can cancel their participation anytime that they want. They can also, and just go back to the old way, looking for a proxy card and read the proxy. And they can override in a given year any of their election by completing the proxy card for that year. So if you have, if you're an ExxonMobil shareholder and you elected to follow the entire board recommendation, sort of option A we talked about a minute ago, and in a given year you want to withhold against a director, or there's a contested election and you want to vote in it, all you have to do is get the proxy card, which ExxonMobil is going to be obligated to send you anyway, and you can vote it, and that will override the perpetualness, the perpetual proxy that you'd filed with them. So one of the things that's worth discussing for a minute is kind of legally what happened, because this took the announcement took the form of some SEC relief. So what just happened there?
Yeah. So I mean, just again, if shareholders opt in, they have these two choices: either always vote with the board recommendation, or always vote with the board except contested director elections or mergers that require shareholder votes. So I mean, just to really be clear, it means that if you go into this program, you will always be voting with the board for shareholder proposals, for vote no campaigns, and for executive compensation. That is not a variation. And
equity issuances.
Issuances that are not
the auditor.
Nobody, even the brokers can vote for the auditor. I'm not terrible.
Right, exactly.
Yeah. So, but you can always change your mind, and you can change your mind in one of two ways: by completely dropping out of the program entirely. But you have to do that before the next proxy comes out. So that would be for going forward, or in any given vote, you may decide just cast your own proxy in the normal way, and that overrides the automatic vote. Right. And so the idea is that Exxon went to the SEC to get no action relief. So the idea here is that a lot of things under the securities laws are really complicated, and it's not clear whether any one thing is legal under the law. So a careful attorney, rather than just doing it and saying, come at me, will actually approach the SEC with a letter that says, we plan to do this program, and here are exactly the specifics of how we'll do it. And we think it's legal for XYZ. What reasons? What do you think? And then the SEC will respond. And one way it can respond is by saying that is totally illegal, and we will absolutely sue you if you do it. But the other way they can respond is by saying, issuing a no action letter, meaning, we will not take action against you if you do this exactly the way you've laid out, which is essentially their way of saying we think it's probably okay. But
and that's from the staff.
It's from the staff. So that's the thing about it. It's not binding position of the SEC, even for another person who does the exact same thing. Like, unless there's been some sort of approval at the higher levels of the commission, it's not precedential. People study these, but you kind of have to if you want to be safe. I mean, and I suppose somebody might take their chances, but if you want to be safe, you really kind of have to get no action.
And Davis Polk is the firm that did this. If Davis Polk gets a dozen calls this week, which I am confident they did. So each of those companies is going to have to be wise to seek no action relief.
I'm guessing they would be pretty safe if they just did it. But technically, no action letters are not precedential, and they're supposed to be good for the one person doing it. So in this case, the reason there was the legal issue is that the regulations actually say that you can't collect a proxy that lasts more than a year. And so this is technically them collecting a proxy that lasts indefinitely until the retail shareholders actually they call it standing voting instructions, which is how it's been phrased in the term for institutionals. But and Exxon's argument for why this shouldn't count as a perpetual proxy is because it's going to be so incredibly easy to override or dropped out that it's not really all that perpetual. And I guess the SEC agreed with that argument because they issued this no action letter.
Right. So I read all this pretty thoroughly. I posted about it, and I know you looked at it too. There were a couple things that jumped out at me when I was reading the SEC no action letter, which essentially was a really short letter. It's easy to find. That said, as long as you do these 3 or 4 things, we're cool. We won't recommend to the full commission that they go after you. First is that letter was dated, I think September 15th was Monday. So Monday, September 15th. Okay. ExxonMobil's request for no action relief, they wrote an 8-page letter, with these very long, detailed arguments about why this is good and shareholders are dying to have this and so forth, was also dated Monday, September 15th, the same day that the SEC issued their no action letter. Yeah. I don't know what you make of that, but I know a lot of.
They must have been talking. They must have been going back and forth with the SEC.
Yes, they had to have been in touch with the SEC. I mean,
it's not just that I don't think that the SEC reacted that quickly. It's that I think it's much more likely that they had different versions of the program and they kind of negotiated. Exactly how. I think that's my best guess. I don't really know. But my best guess would be that they had different versions of exactly what they were going to do, and they were talking to the SEC, and then finally they figured out how to do it so the SEC would be okay, and they put that in writing.
Right, because there are ESG proponents that fantasize about one-day turnaround.
There's no question. The SEC did not look at that in one day and get back to them. So something else was happening.
Right. The other thing I noted, I mean, the SEC's no action letter, as I said, was pretty brief. It just said,
they always
okay,
are.
Cool.
They almost always are. It's right. Striking when once in a while they're not, but that's always very striking.
Yeah. Well, there was something else that struck me. So if you, like I said, the ExxonMobil request, as well as some of the other, they had a news release about this and some little article they wrote, was very emphatic about how much their shareholders really, really want this. And they were emphatic, but in some really vague statements. So, they said, retail investors, many of whom are retired and depend on our dividends to support their livelihoods, have voiced significant frustration over the annual time commitment required, blah, blah, blah. Retail investors are eager for a more accessible way. ExxonMobil's long received feedback from retail investors. They would welcome the ability to give a standing voting instruction. Yeah. So, there was a lot of this very, big language about how this is really critical. And there was absolutely no evidence that was at least presented publicly. It's not like it doesn't, I don't know, maybe they did, survey a base of retail shareholders and say 80% want this, or, collect a whole bunch of verbatim comments from their call line or something like that. And so I wonder whether the SEC kind of pushed back on this. I kind of doubt it. So it would have been nice had we seen a little more other than just what are basically some random anecdotes at this point from some loyal ExxonMobil retirees about this. So that was something else that the SEC that kind of struck me about what the SEC sort of did or didn't do. So anyway. Yeah, go ahead.
No, what I was going to ask you, I know what I think. What do you think?
Okay, I will say what I think, and then I want to know what you think. And I think there's in some respects I think this is a little positive, but those are kind of minor. But at its core, this is a perfect illustration of and response to something we've talked about before, which is rational apathy. Okay, rational apathy is the idea that the cost of voting, and it's voting in anything, voting in civic elections, voting in board elections, that the cost of voting exceeds the benefits. So the voters are rationally apathetic, and that is especially true in corporate governance and board elections and so forth. And it's worth noting that there are sort of two kinds of costs. There's the cost of research, the cost of getting educated about the subjects and so forth. And for ExxonMobil, that means the cost of, learning who the nominees are for a board election and reading all the shareholder proposals and looking over the equity issuance, everything that you're being asked to vote on. And then the second cost is the actual cost of casting the votes, which in the U.S. is a famously high cost, especially for retail investors. The proxy process is painfully arcane. And, trying to figure it out.
The counting process.
Well, the counting process is even worse, in part because the voting process is so crazy. Yeah. But, finding the control number and getting the card and knowing in a consensus election whether you want the blue or the green card.
No. This is why I'll remind, when Disney was fighting off two separate activists, they put out that video for retail shareholders that was just how to vote. Right, it was find the control card. They had it narrated by the guy who does the Disney Parks narration so that retail would know how to vote.
So what ExxonMobil has done is basically reduce those costs. They've made it a lot easier.
The costs on the actual mechanics side. They didn't reduce the
have reduced it, but they've also reduced the cost to a loyal, and I'll get to this, to a loyal ExxonMobil shareholder. And this, I think, will illustrate why the impact of this program isn't going to be as bad as people think. That people who are usually ExxonMobil voters, supporters, the loyal retirees that, just love whatever the company does. It makes life easier for them because they were going to vote for whatever the company wanted anyway.
It's not saving them any research costs is what I'm saying. That if you already knew you didn't have to do research,
that's a good point.
Then it saves you there are real costs of remembering to vote, and it's particularly a cost if you have more than one company.
Yes, right, or more than one account or whatever. Yes. So and so, as an illustration of this of a fascinating subject, rational apathy, I think it's actually pretty dead on. Now we have to ask, okay, is it, what's this gonna what's this gonna mean for like voting at ExxonMobil annual meetings? Is this going to really increase or whatever? And ExxonMobil in their material said that roughly, I think 40% of their shareholder base is retail, which is high relative to other companies, and that they get 25% participation from that 40%, which is also, and again, data on this is really scarce. Okay, but on kind of retail, especially retail participation, it's not hard to figure out what retail holdings are, but retail participation in annual meetings is hard. Companies don't disclose it, which is something we've talked about.
Yeah.
But my kind of vague sense from looking at this and talking to people is that 25% retail participation is actually pretty good. And again, it's ExxonMobil. They've had a lot of high-profile AGMs and so forth in the recent years. So, they're kind of bringing out at least some. Now, whether this is going to matter and it's going to make that 25 into 50, I don't think so.
You don't think that many people participate in the program?
No. I mean, they may get a decent participation from their current investor base. But these are all people that were voting the company recommendation anyway. So they're just it's going to make their life easier. My sense is it's not going to, increase dramatically the turnout
but that's what they obviously want to do.
AGM. Oh, that's what they're trying to do. Yeah. I mean, the whole, because it's ExxonMobil, who is, famously allergic to shareholder ESG proposals, that's where the ESG community is enraged.
Yeah, because what Exxon wants to do. I mean, they're not doing this because they just love retail shareholders. They're doing it because they want to bank votes in case of both big A and little a activism. Both, they want to bank votes against the ESG proposal. I mean, they already tried suing their own shareholders, which we talked about previously. Now they're trying to build up a bulwark against shareholder proposals. That's not an option to opt out of on their thing.
Right.
And
yes. Go ahead.
And they want to build up a bulwark against if they're ever challenged again in an actual proxy contest.
Right. So that was one thing that I think could have really made this a lot more or less controversial, I don't know, was for ExxonMobil to allow people to elect something other than supporting the company recommendations.
Exactly. Yes, but that would defeat the whole purpose of the program.
Oh, that's unreal. I mean, if they were interested in really dealing with rational apathy and making life easier for shareholders, they would have allowed that.
Yeah, but that is not what their interest. Their interest is banking and defense against activism.
Right, that reveals their motive, which is to make life harder for activists.
But you don't think it'll have that much of an effect?
I don't. My sense is that it's not going to turn that 25 into 50. It probably isn't going to turn it really into 30. Okay. ExxonMobil will really have to do a big push.
To get people to
multiple mailings and lots of communication and they might. I mean, if they do,
they could, but they can't even promise retail shareholders it'll spare them emails. Like, it's not even do this and you never have to hear from us again. It's the opposite. It's do this and you hear from us more.
Once a year, you're going to get a reminder and the proxy materials.
Yeah, which they would get anyway, but yeah.
Yeah. So, and the other big question is are other companies going to follow?
They will. I've already seen the law firm memos are already going out recommending it for companies, especially if they have large retail shareholder bases.
Yeah, so my sense is that even though it may, in ExxonMobil's case, make 25 into 27%, or in some other company's case, may turn 19 into 21 or whatever, companies are looking for any edge they can. Wow. And if ExxonMobil figures out the processes needed to do this, because the processes needed to do this are not, simple and straightforward. Getting ththese agreements in place, tracking them, allowing people to change them. How a proxy card overrides. They're going to make, create a lot of lucrative work for the Broadridges and the custodians. Okay, but if they can do this in a even halfway efficient way, there'll be a lot of companies that are going to be, wanting to do this. Davis Polk's going to do quite well.
Yeah. Well, the other law firms are just going to imitate it.
So we were about to. So I've sort of said, and I don't, like I said, from a rational apathy standpoint, I'm okay with this. How ExxonMobil did it was not necessarily, really try to be kind to shareholders as much as trying to help themselves. Yeah. And I don't think it's going to have that much of an impact. But we started saying, what do you think now?
Well, okay. So first of all, I mean, this all comes back to retail shareholders don't vote very much. I mean, but it's assumed that their general preference is with the board, which makes sense because retail shareholders aren't activists. They don't get in the stock to improve it. They're there and they're not passive. If they own directly, they're not passive. They're not indexing. So if they own the stock, that tells you that they like what's going on with the company. So it's not surprising that they would support the board. But the thing is, they're giving them this board-only template, and as is well known, institutional investors don't have board-only templates. They do have that as an option, but they have a wide variety of different. They can either custom design their own template or they can take thematic policies. Institutional investors have a wide variety of choices, and there are apps now and programs to try and advocacy to get retails to have access to those kinds of templates, but they don't now. So of course, this really puts a thumb on the scale in favor of boards. Now, but I think it's funny because, as I just said, Exxon, as we said, is an activism magnet. And what really stung it aren't just the shareholder proposals, which it sued to block, but also, it had the engine number one thing.
Oh, right. They lost some board seats about 4 years ago.
And two of those people are still on the board. And they're joining with this project of getting rid of future activism, which I think is funny. Yeah. But, okay, so I think if other companies will do this, my concern is that once, like, if you assume a retail investor probably doesn't just have Exxon, but probably has other companies as well. It won't be wide. It won't be like 2,000, but it'll be some. And each one of these companies do that. That means now the retail investor is being spammed with lots and lots of opt-out email, which makes it even more likely that they will never opt out. I mean, the whole point here is that retail doesn't pay attention enough to vote, so it's very likely that once they've opted in, they'll never opt out. And the value to companies of this is that the more companies do it, the less likely it is that once opting in, shareholders will opt out, because all they're going to do is be getting constant reminder, you can opt out emails, and they're just going to go straight to the delete spam folder.
Right. But so no one's going to think critically about the decision after they made it.
Exactly. The more companies do it, that's exactly what's going to happen. But what I would like to see, I think that there should be a situation where retail should be able to choose templates. But part of the issue right now is, like, you have to pay for them. Like, you could sign up for a couple of programs, but you'd have to pay for them. And most retail shareholders do not want to pay. But I think I can imagine a world where, like, nonprofits and advocacy organizations develop for free voting templates if they could just figure out how to get the technology to be, cheap or no price to the shareholder. And you could pick any advocacy template you want. Like, there's the Sierra Club template and the NRA template. And you pick whatever one you want, and it not only can cast votes for you, but that also would give them leverage with negotiating with the company. So the Sierra Club banks, like, I've got all these retail shareholder votes that I'm allowed to cast however I want. Now, when I approach a company and I say, I want you to improve your environmental record, I'm really credible about voting for your directors and voting for your comp
I have these many shares that I've already
and I think that somehow, like, make it free to the retail shareholder, and whatever advocacy organization wants to develop the template, they can, and the shareholder can pick it.
Wow. So this is something the SEC actually could do.
It's something it could do.
Make the companies. Yeah. Look, if you want to bank votes for your board slate, how about you also pay to allow company shareholders to choose?
It should be like one option offered by a brokerage that's part of a brokerage thing, though, and just like, here, go to your menu. Do you want your votes? Do you want your votes voted? Do you want to do it individually, or do you want to pick a template? And you just pick.
Wow. All right. Let's see. We'll have to see what. I mean, the big thing is if companies are going to follow. And you're right. The law firm memos are all over the place, and I would imagine there's many that are pleasantly intrigued by this opportunity. So anyway, I think we've covered this one pretty thoroughly, haven't we?
Yeah.
So all right, let's wrap up then. It's been great talking to you about both ExxonMobil and quarterly reporting. We will probably return to both sometime soon. Mm-hmm. So there's more to expect from us. So this is Shareholder Primacy, hosted by Ann Lipton and me, Mike Levin. I'm an independent activist investor and advisor to investors about their activist situations. Ann is professor of law and Lawrence W. Demuth Chair of Business Law at the University of Colorado Law School. You can find me, Mike, at theactivistinvestor.com and Ann at law.colorado.edu. Our podcast is produced and distributed by Free Float Media. Thanks for listening, and we'll talk again soon.